Folks, let's have a little talk. You've worked hard. You've saved your money. You've found the perfect house. The one with the big backyard for the dog. The great school district for the kids. You're on the goal line, about to score the touchdown of home ownership. And then, bam! One small, seemingly innocent decision knocks you flat on your back. The deal falls apart. It sounds dramatic, but I see it happen all the time. One bad choice, one impulsive purchase, one moment of not thinking. Any of those can stop your home loan dead in its tracks. It's a gut-wrenching experience. You do not have to go through it. Getting a mortgage is not a sprint, it's a marathon. The last few miles are the most critical. During this time, the lender, the underwriter, is watching your financial life under a microscope. They're not being nosy. They're checking your risk. They want to see stability. They want to see consistency. Make a big financial move and you change the picture. You throw a wrench in the machine. The lender has to stop, reevaluate, and ask new questions. That causes delays at best and denial at worst. Alright, let's talk about the number one dream killer I see: the new car. You get pre-approved for your mortgage, and you feel like you're on top of the world. You're thinking, hey, I'm about to be a homeowner. I deserve a new set of wheels to park in that new driveway. So you head down to the dealership. That new car smell hits you. The salesman tells you what a great deal you're getting. Before you know it, you've signed the papers for a brand new truck or SUV. You've just made a massive loan-killing mistake. It's like celebrating a touchdown when you're still on the 20-yard line and fumbling the ball. Here's the deal. When you take on a car loan, you're adding a significant new monthly debt. The mortgage lender has already calculated your debt-to-income ratio, or DTI. That's the magic number that tells them how much of your monthly income is already spoken for by other debts. When you add a $500 or $600 car payment, that number shoots up. Suddenly, the loan that looked perfectly safe to the lender now looks risky. Your DTI might now be too high to qualify for the mortgage you were approved for just a few days ago. Even if the new payment doesn't push your DTI over the edge, the act of applying for new credit causes problems. The car dealership runs your credit, which results in a hard inquiry. This can ding your credit score by a few points. More importantly, the lender gets an alert that you've taken on new debt. The underwriter, who was about to give you the final stamp of approval, now has to stop the entire process. They have to re-verify your income, recalculate your debts, and reassess your entire file. This causes delays, stress, and a whole lot of unnecessary paperwork. So, what's the rule? It's simple. Do not buy a car, a boat, an RV, a fancy riding lawnmower on credit while you are in the process of getting a mortgage. I don't care how good the 0% financing for 72 months deal sounds. It can wait. Drive your old, paid-for clunker for a few more months. After you have the keys to your house in your hand, after you've signed all the closing documents, then you can go car shopping. Until that moment, your new driveway will just have to wait for its new occupant. Patience is a virtue, and in this case, it's a virtue that gets you a house. You've got a great new job offer. More money, better title, corner office, the works. It's a fantastic opportunity, and you want to jump on it. But hold your horses. If you're in the middle of the mortgage process, changing your job can be like swapping out a pilot mid-flight. It can be done, but it's incredibly risky and can cause some serious turbulence. Lenders absolutely love stability. They want to see a consistent, predictable track record of employment and income. A sudden job change throws a big question mark into your file. They get nervous when things change. The main issue is income verification. Lenders typically want to see at least 2 years of employment history in the same field. If you switch from a salaried W-2 position to another salaried W-2 position in the same industry with a pay increase, you're usually okay. But you must tell your lender immediately. They will need a written offer letter and to verify your new employment and salary before moving forward. Any delay getting that paperwork can delay your closing. It's not a deal breaker, but it is a speed bump. Where you get into hot water is when the nature of your income changes. Let's say you leave your steady engineering job to go into a 100% commission-based sales role. To a lender, that's a huge red flag. Commission or self-employment income is considered variable. Lenders want to see a 2-year history of that kind of income to feel comfortable that it's stable. If you don't have that history, they often can't count the income at all, which means you no longer qualify for the loan. The same goes for starting your own business or switching from full-time to part-time work. The rule here is communication and caution. If you are even thinking about a job change, the very first person you should call is your loan officer. Don't quit your job. Don't even give notice. Talk to them first. Explain the situation, the new company, the new role, the pay structure. They'll tell you how it impacts your loan and what documentation you need. Sometimes the best advice is to ask your new employer if you can delay your start date until after your home loan is closed. A great new job is wonderful, but not if it costs you your new house. This one trips up a lot of well-meaning people. Your sweet Aunt Carol gives you $10,000 to help with the down payment. You run to the bank and deposit the cash into your checking account. A few days later, your lender calls. Big problem. They see a large, unexplained deposit and can't use it toward your loan without proof. Federal laws like the Patriot Act require tracking money laundering. Lenders must source all large deposits. It's a legal requirement. Any cash that magically appears is a red flag to an underwriter. They call it mattress money. They don't know if you saved it up. They don't know if it was a gift. They don't know if it's a secret loan from Cousin Vinny charging crazy interest. A secret loan is undisclosed debt. A mortgage, no. Without a clean paper trail, the lender must ignore that money. If you were counting on it, your loan hits a brick wall. How to handle gifts correctly. It's all about the paper trail. If a family member gives money, follow the process. First, a signed gift letter. It states the money is a true gift and no repayment is expected. Second, document the transfer of funds. Best, a cashier's check. Deposit the check and keep a copy and the deposit slip. Even better, wire the money directly to the closing company. Rule: document everything. Don't deposit large cash without talking to your lender first. If you sold a car or major asset, keep a bill of sale. Keep a copy of the check you received. Keep records of every significant transaction. It's a hassle, but organization prevents underwriting delays. Your lender isn't trying to be difficult. They're following rules. Help them help you by keeping your financial records clean and easy to follow. You're walking through your favorite home goods store and the displays are calling your name. That beautiful leather sofa, that big screen TV, that fancy stainless steel refrigerator. And what's this? The store is offering a fantastic deal. No interest for 24 months if you open a store credit card today. It sounds so tempting. You're already planning where to put the new furniture. Stop. Put the credit card application down and walk away. This is a classic trap that can seriously jeopardize your mortgage. Opening any new line of credit during the loan process is a bad move for several reasons. First, just like with a car loan, the application itself triggers a hard inquiry on your credit report. This can cause your credit score to dip by a few points. While a small dip might not seem like a big deal, it can be. If your score falls below a certain threshold, it could change your interest rate or even disqualify you from the loan program you were approved for. It's a completely unnecessary risk to take for a new couch. Second, a new credit account, even with a zero balance, can still affect your loan. The underwriter will see the new account pop up on a credit monitoring alert. They will have to stop and ask you for a letter of explanation. Why did you open it? What do you plan to buy? They will have to factor in a hypothetical monthly payment for that new credit line, even if you haven't bought anything yet. This adds more paperwork, more questions, and more delays to your closing timeline. Don't give them more things to worry about. The rule is to put your credit on ice. From the moment you apply for a mortgage until the day you close, do not open any new credit accounts. Don't apply for a new credit card. Don't co-sign a loan for anyone. Don't finance furniture or appliances. Pay your existing bills on time. Keep your credit card balances low or at zero. Your financial life needs to be as boring as possible during this period. The new furniture can wait. Trust me, it will feel much better to buy it after you have the keys to the house it's going to go in. Section 7. The paper chase. Ignoring your lender's requests. The mortgage process involves a mountain of paperwork. It's just a fact of life. Your loan officer and the underwriter are going to ask you for documents. Lots of them. pay stubs, bank statements, tax returns, W-2s, letters of explanation. These requests can feel annoying. You might think, I already sent them my bank statement. Why do they need another one? It's easy to get frustrated and put that email on the back burner. This is a huge mistake. Time is of the essence. Closing dates are fixed. Everyone is on a deadline. When an underwriter requests a document, they can't move forward without it. Every hour you delay is an hour the loan sits idle. Wait a day or two and you may push the closing date. Ignore requests and the lender may suspend your file. Your deal could fall apart. Think of your lender as a partner. They are on your team. When they ask for an updated pay stub, it's often because the one you sent is older than 30 days, and regulations require a current one. When they ask for all pages of your bank statement, even the blank ones, it's because that's the rule. The faster you respond, the faster they can check the boxes toward final approval. Be proactive. Create a dedicated folder for loan paperwork. Respond immediately and completely. Check your email multiple times a day. If your loan officer calls, answer. If they ask for a document, send it the same day if possible. If you don't understand a request, ask for clarification. Don't get defensive. Just give them what they need. A speedy, cooperative attitude smooths the process and gets you to the closing table on time. Your responsiveness is a key ingredient to success. Section 8. The Big Secret. Why hiding life changes is a bad idea. During the mortgage process, you might feel like you need to present a perfect, unchanging picture. So when something big and potentially messy happens, your first instinct might be to hide it. Maybe you and your spouse decide to separate. Maybe you find out you have a new dependent on the way. Maybe you get into a fender bender and your insurance is going up. You think, I'll just keep this quiet until after we close. What they don't know won't hurt them. Wrong. Keeping secrets from your lender is a recipe for disaster. Lenders do last-minute checks on everything. Your credit. Lenders do last-minute checks on everything. Your employment. Lenders do last-minute checks on everything. Your public records. The truth will almost always come out. Imagine finding out on the day of closing that your loan is denied because the lender discovered a new legal judgment against you that you failed to disclose. Or imagine your co-borrower spouse is no longer part of the equation, which completely changes the income and debt calculations. These aren't small details. They are fundamental changes that can completely alter your eligibility for the loan. Hiding information destroys the trust between you and your lender. When they find out you weren't upfront with them, they will question everything else you've told them. The best-case scenario is a major delay while they re-underwrite the entire loan with the new information. The worst-case scenario is an accusation of mortgage fraud, which is a federal crime. It's simply not worth the risk. Lenders have seen it all before. They know that life happens. They would much rather deal with a problem upfront than discover it at the last minute. The rule is to be an open book. If you experience a significant life change during the loan process, you need to inform your loan officer immediately. This includes changes in marital status. This includes a new financial obligation. This includes a change in the number of dependents. This includes any legal trouble. Yes, it might be an uncomfortable conversation. Yes, it might complicate your loan. But being honest gives your lender the chance to work with you to find a solution. They are problem solvers. Give them the information they need to do their job, and you'll have a much better chance of reaching your goal of homeownership. Section 9. The Finish Line. Your path to home ownership success. We've covered a lot of ground. We've talked about the dangers of new cars, job changes, mystery money, and spending your down payment. During the mortgage process, your financial life needs to be stable, steady, and boring. This is the one time in your life when boring is beautiful. The goal is to present the underwriter with a file that is so clean and straightforward that they can stamp approved on it without a second thought. You have the power to make that happen. Think of these rules as your guardrails on the highway to homeownership. Don't make any large purchases. Don't apply for new credit. Don't change jobs without talking to your lender. Don't move money around without a paper trail. Respond to all requests for documents immediately. Be honest about any changes in your life. It all boils down to two things: common sense and communication. Before you make any financial decision, big or small, ask yourself one simple question. Could this affect my mortgage? If the answer is maybe, then your next step is to call your loan officer. This process might sound intimidating, but it doesn't have to be. You're in the driver's seat. You've already done the hard work of saving money and building good credit. The final stretch is all about discipline and focus. Keep your eyes on the prize. Those keys in your hand and the deed to your own home. Every small sacrifice you make during this short period, driving your old car for a few more months, waiting to buy that new sofa, will be worth it 1,000 times over when you're standing in your very own living room. You can do this. You are so close. Don't let a rookie mistake at the end of the game cost you the championship. Stay disciplined, communicate with your team, and keep moving forward. Follow these simple guidelines and you'll sail across the closing table without a hitch. The feeling of unlocking your own front door for the first time is one of the greatest feelings in the world. Stay focused, make smart choices, and get ready to enjoy your new home. You've earned it.